What is 2026 about?
It is very important to see that the market is likely to continue expanding with only one very important difference.
How can Europe be successful in such a difficult market environment?
We see that the sectors that can benefit the most are those that can make use of AI technology smartly, but do not position that as the core focus.
Do you see an AI bubble that is building up here?
From what we saw in 2025, 40% of the performance of the S&P 500, for example, was driven by the technology stocks, which is a massive concentration factor.
It's a big show, right? To bring a billion, multi-billion, a decacorn, or maybe 100 billion company to the stock exchange. People will be crazy about it. Some of you guys are thinking of buying stocks of an OpenAI, etc. once it's listed. And I will tell you why I won't. Hello and welcome to Venionaire Insights, our format on insights deep into the venture industry and private equity. Today, I'm in a conversation with our lead analyst, Denis Voldman. Welcome, Denis.
Hey, Berthold. Happy to be here.
And the occasion why we have this episode is actually the fresh off-the-print market report, Market Outlook 2026. It's available in print. You can download it online. We will have this with a QR code here for you. Obviously here in the show, we will give you some key insights and takeaways so that you don't have to read through these almost 50 pages. This is an incredible piece of work, Denis. How long did it take you to put all of this together with the team?
Well, I would say it actually took the entire year of, first of all, observing the year, looking at the markets, looking at the most important data that we used. And then, of course, a few tough weeks after the year's end of actually writing that down for you guys.
Yeah, it's always speed matters, right? You need to deliver quickly so that this actually stays on time and is available. Thank you for all the effort. What is your key takeaway? If you would say in a few sentences, what is 2026 about? What is the base case?
I think, first of all, it is very important to see that the market is likely to continue expanding with only one very important difference. Now, investors would not look so much only into the earnings growth of the companies that they have and other fundamentals, but also to their discount rates, which are actually changing. This is very important, not only with what the central banks would say about the rates. This is also very important for the long-term positions that they typically take: bonds, private equity, venture capital, and other investments. This is where the duration factor would be most important. So the investors would not only look at the fundamentals, but also consider their discount rate, whether it actually makes sense to take such investments.
In TradFi, we always call this the asset shift, right? From the low interest rate environment, which is usually very good for equity, listed and also private equity. But then when the private markets get more competition because the risk-free rate rises, so you get more interest rate on the lending, right? By buying bonds, you're actually providing money for lending. Then obviously the opportunity cost of taking risk of an equity asset, listed or unlisted, increases, right? And this then also shifts in a specific demand for more quality. Now, is this quality more the financial stability of a company? So are we talking more of a later stage, more mature company, or is it just more extreme bets?
That's a good question. From what we see right now, and especially from what we saw last year, is that the spending into the AI infrastructure increases. Now, last year it was around $400 billion in the US standalone. It will be likely around 500 to 600 billion in this year, 2026, which makes investors wonder, basically, should they actually care only about the spending? So is the best player the rock star, the one that spends more, or the one that deploys more efficiently? So I think this question is exactly the question that the investors would be wondering this year. And answering your question, of course, stage matters. But the capital efficiency, the capex efficiency, will also play a huge role in this year. So the investors would stop only thinking about how to get more capital in their companies, in their portcos, but also start thinking whether they can actually deploy that efficiently. And this is the type of companies that would win this year.
What really surprised me was when I looked at the data of our quarterly report on the venture sentiment here in Europe, the European Venture Sentiment Index, is that it was quite a, I would say, sideways momentum we saw, right? So it was really, the market didn't decide. It was a bit, you could say, compressed, right? So there's no direction, sentiment going down or up. It's kind of staying the same. While in the same time, we saw that equity markets were rising, in particular technology stocks. And what I read in the report and also learned is that a lot of sectors actually did not do good, right? This is not only North America and Europe, but also in other parts of the world. So consumer, healthcare, energy sector, etc., went down. But on the other hand, we saw that the technology stocks were just growing so much that the overall growth in the economy was basically carried and dragged by those technology stocks. We have these magnificent seven, right? We call them on the large indices of stock markets. So the Metas, the Googles, the Amazons, all of these big tech giants. Will this stay the same? Will the technology companies in the listed environment, due to all this expense that they have in AI, will they keep on dragging the market up and making up for the losses in other sectors? Or do you see an AI bubble that is building up here?
So that's really spot on, I think, of what we try to delve into the report. Now, from what we saw in 2025, 40% of the performance of the S&P 500, for example, was driven by the technology stocks, which is a massive concentration factor from what we see. And of course, we cannot argue about seeing the AI bubble or anything like that bursting next year. This is quite unlikely. From what we can see is that the markets actually already started to price in different markets and different sectors. If we take a look at, for example, the European stocks performance against the S&P 500, Europe actually slightly outperformed S&P last year. A very marginal outperformance, yet it's still there was outperformance. If we're gonna take out the technology sector from the equation, we're gonna see even a better result. So we see, for example, in Europe, other sectors perform better. And this is likely the trend we're going to see also this year. As said, the US is heavily now dependent on, for example, the AI companies making some IPOs. If we see this exit window opening for them, we can see, for example, even a higher expansion on the AI sector. Now, Europe likely would gain from that because investors would see other sectors in Europe and would continue investing in them even more. But also other emerging markets as well.
But see, I mean, I see something good and something bad in that, right? On the one hand, yes, it's a big show, right? To bring a billion, multi-billion, a decacorn, or maybe 100 billion company to the stock exchange. That will certainly, have an eruption momentum in media, right? People will be crazy about it, right? I'm sure some of you guys are thinking of buying stocks of an OpenAI, etc. once it's listed. And I will tell you why I won't. I won't. And I can tell you exactly why. I do think that these companies have exceptional technologies, but I do also think that they have inflated valuations, and there is just a lack of business model yet. And for that, I think also there is a lot of investors that have chipped in big amounts of money, right, to make this work. And when there is an IPO, they certainly have lockup periods, but they want to cash out. And what happens if larger investors that from the private cycle, right, have invested and they stayed with the company, let's say, for 5 years, right? They want to get their returns, so they will sell. And when they dump those stocks to the market, there must be an insane amount of liquidity to pick that up, right? And this only would maintain then the valuation. So my take is that actually with the IPO of those large companies, we will see the beginning of a correction in the technology stocks, right? Because suddenly, due to the fact that people are cashing out, the stocks will correct, and this will also drag the other technology stocks down. And this is my gut feeling, right? I'm sure this is not something we have analyzed now in this data, but it's just from experience from the last almost 20 years where I've been involved in trading in these stocks, technology companies, etc. You've always seen this shift, right? And the higher the amount, right, you take into the public markets, and the higher you want to cash out, right, the more momentum you create. So it's a good and a bad thing, right? I think we have to be careful on this one.
The funniest thing is that actually the data can confirm your proposal. Now, from what we see, especially in the US, the performance of companies that recently had an IPO has not been very positive, so to say. So typically, the majority of IPOs in the last 5 years actually then right now perform worse than their entry price, which actually confirms what you're saying. And I think you can basically find arguments for both ways, but investors definitely should be aware of this.
And in the same equation, we also must say that AI is changing the world, right? And it's changing it for good. This is not all bad, right? We need better robotics. We need better AI. And I think agentic AI and everything we have with the ChatGPTs and the Geminis and N8N and whatnot, right? All of these solutions are cute, but they're only the tip of the iceberg. It's only the start. There will be much, much more. And I'm sure that the business models and the value that these automation mechanisms and AI brings to businesses in all kinds of sectors will be very, very big and will actually generate even bigger wealth for the world economy. Right, so I'm really not Dr. Doom for AI. I'm just worried on the short term, right? As the incentives of managers in listed companies is always on the short term. And if I'm managing company from other people, like any wealth manager, fund manager out there, then I have to be careful in how to not harm on the short term my investors. What I also recognized is last year we have seen an incredibly strong market in stocks if you picked right. But then on the other hand, crypto didn't do well. It stayed volatile, yes, but also we saw a lot of altcoins going down and like even Bitcoin corrected. We have the strongest economy in the world with an administration that is quite in favor of crypto. We have a regulation in the European Union that is crystal clear with MiCA. There is a new tax regulation with CAR from OECD, the AC8 coming in, etc. So we never had this amount of clarity. We never had this amount of stability. We never had actually this asset class as much integrated into the traditional finance sector as it is today. We have never seen as much institutional capital going into this. But at the same time, they were correcting. And I wonder, are we at the tipping point to a crypto winter, or is this just maybe also an asset shift, which we have to still learn, right, for now? While we have made money with equity, maybe we get a bit uncomfortable, cash out from equity, and would then lean more towards crypto. What's your take on that?
So we definitely think there's been a little bit too many ups and downs last year in terms of the crypto market. But from what we see, the environment, the political environment, the economic environment, the legal environment is actually preparing for this expansion. Whatever you mentioned, the frameworks that are being implemented are definitely helping. Now, some instance that we see is actually so typically up pretty much before end of last year, the Bitcoin performance was heavily related to the M2 supply. Now, this connection is for the moment kind of broken. And in this case, we see either this is the end of this correlation that we saw on the market before, or Bitcoin is going to pick up. Now, another thing that is a little bit more pro-expansion is that we see more and more TradFi players going into crypto very seriously. We see the flow of stable coins that grow at the pace that can soon surpass the giants like Visa or MasterCard, which is actually very, very outstanding. Now, we also see a very notable movement in the market that many crypto brokers, many TradFi companies are exploring options how to offer the crypto baskets to their clients, so-called indices, ETFs, DTFs, and so on and so forth, which is another layer why we believe at Venionaire that the market has so much potential this year.
Fully agree. I'm very proud of our Web3 team that last year we were able to launch the first index, Venionaire Index for Layer 1. And this is a selective index where you have a very, very thought through methodology where you as an investor, you don't have to worry like which layer one will monetize the best. You're always well weighted, right? Well balanced in the top-notch cryptos you want to be in and in those fundamental layer ones. And what I like particularly the most about it, and I learned a lot from the team here, is that the layer ones are basically the basement, right? It's where you build the house on top, right? So without a strong layer one, there is no monetization, there is no application that you build on top. So a solid layer, right, will create an environment where a lot of applications can be built upon. And I think it was a genius move to focus on the layer ones. And I'm also excited to see that the first products are replicating the index and are actually picking this up. Funnily for you as traders out there, you should think yourself why so many crypto companies are talking about indices at the moment. I'm not sure if that's clear. For brokers, it's a nightmare to have this summer and winter in crypto, right? Because when crypto winter hits, obviously valuations go down. So you have the coins in custody. You have to make sure that they're not getting stolen, and this infrastructure costs money. Now, for the most investors, they hodl, right? So they hold their assets like Bitcoin and just don't look at it, which is totally fine, right? You shouldn't be trading. Trading just fills the pockets of, your neighbors or the rich people that have understood how the game works. But for an exchange, that's terrible because without the trade, they don't make cash. They don't earn money. So for them, they want you to trade. An index naturally rebalances. So this creates automated trades while you are holding just one index, so basically one coin, for example, replicating an index, but then in the background, there is trades happening, right? And these trades are good for the exchanges. Now, on the other hand, for you as an investor, this is also great because you don't have to keep an eye on all the rumors on what's happening. Did this team from a Solana application lose their core developers or not, right? You don't have to follow that this tightly because with an index like S&P 500, right? You're invested in the market, but you're not invested directly into single companies. And I'm sure there's quite a lot of people that have like an ETF of S&P 500 and they have no clue what is within the S&P 500, which constituents get dropped out, which ones come new in. And there is actually fluctuation in those indices in traditional markets as well. And this fluctuation we also see in those indices. So I'm quite excited about that as well. I do agree that this is actually some innovation we see with the professional market players. And I think there's also some strategic investments that Venionaire will be doing in this sector. We just, in fact, did one in December, but it's not announced yet. So sorry for that, but you'll hear soon. Having spoken now about the general markets on liquid, on private equity venture, the global perspective, let's dive a bit into technologies. What kind of technology sectors do you think are interesting at the moment in terms of scalability? And let me narrow it down a bit. How can Europe be successful in such a difficult market environment? What would be your take?
So we see after speaking about the potential for an AI boom to burst, for example, we see that the sectors that can benefit the most are those that can make use of AI technology smartly, but do not position that as the core focus. This includes in Europe, for example, Europe is very strong at industrial deep tech. And this sector, we believe, can benefit the most in case we see any AI bubble bursts coming in this year. And generally, if we see any change of this US concentration in the markets, this is where, for example, European industrial deep tech can scale. Now, generally, we're not going to discount technology sector in its core because we see some other technologies out there that are quite exciting. We see that the biotech sector actually excels the most in implementing AI in their operations, which I think is exactly what this sector has been missing after numerous funding rounds that a typical biotech startup needs to raise in order to at least push it to the first round of testing. With AI, this actually speed and also capex decreases drastically. So these are I would say, the two hot topics. And funny enough, Europe is quite strong in both. So we definitely are quite bullish on Europe, of course, but in other emerging markets also. We see a huge potential in Japan. We see huge potential in the Middle Eastern markets. That comes more, I would say, on the fintech side. That comes all for the Middle East. Of course, the general prop tech real estate markets are quite strong. So these sectors where we see the most potential in.
Yeah, I would add for the Middle East the low altitude economy. We have a strategic investment in drone delivery. Funnily enough, a European company where the only test market is in the desert in Riyadh and the wider region of the GCC. We also follow scale-ups, quite good and strong deep tech companies in 3D mobility, 3D logistics, where I'm quite comfortable that we also will see some massive deals here between the Middle East and European players in this sector. I've been lately looking with my team deeply into Scandinavia for deep tech. Here, particularly things linked to the mobility industry. And what's stunning for me from last year is the sandbox, and forgive me for this like implied joke with it, but the sandbox of Egypt, right? And I humbly say that I did not know how strong this economy is. There is so much young talent, well educated, there's great companies, and there is really, really good players, really good investors locally that have understood how to monetize great technologies in North Africa and in the Middle Eastern region. Right. And here we will work out deeper collaborations, because I think really this market deserves to be considered one of the stronger hubs and a stronger bridge with Europe. Another one that I've been missing for many, many years, and this was even more surprising because so many people told me always go to Brazil, go to Brazil, go to Brazil. And I thought, what the hell should I do in Brazil? Right. And I had no idea about it. I mean, I do love the meat, the grilled kitchen and all of that, and the samba and the parties. And I thought, yes, obviously, yeah, a great country and the nature, and, it's the lung of the earth. Right. So for me, it was always the place I wanted to visit as a tourist, but I didn't have it on the map. And forgive me for that. I'm sorry for deep tech. And I was wrong. I was deeply, deeply wrong with that. Here also, you have a massive economy, 220 million citizens in Brazil alone. LATAM is huge. Great education. Right, you see that the talent is educated, the appetite for digitalization and the adoption rate is incredible. People do like their digital solutions. You have very well established industrial players. You have a great energy sector. You even have an aerospace economy, right? So this is a powerhouse where maybe other people out there also, right, had been too ignorant in looking at that. Now, for me, my takeaway on this is, as Europeans, and particularly as Austrians, since we live in such a fragmented European Union with little markets, right, with very, very high-end research, we have all the talents, we have all the IP that is generated, and naturally we have been always used to be, I would say, very diplomatic internationally, because there is no home market. Yes, I know we have 8.5 million people, but that's nothing, right? So we always had this drive to go international and to build bridges to other regions. And I think we forgot that a bit in the tech sector and also in the venture capital industry. So my key takeaway would be, for Europe to be successful is, let's leverage on what we are particularly strong at, and that's international relations. This is where we have our friends, expats from Europe working in the regions that excite us: Southeast Asia, Japan, Middle East, LATAM, right? And maybe not go to those places where the highest competition, right, is on the ground, like in the United States. It has the highest number of venture capital available, but the whole world is racing there. Maybe you should be bold and a bit more brave and go into markets that have stunning growth numbers and less competition. And at least from what I have learned last year in all these different travels that I did, and I know you had been in Japan yourself, right, is European high tech is appreciated in those markets. And I think we can be proud of what we have, and we should be building those bridges, right? Not only sell there and raise there, right? Let's bring value, and let's also import value back. Let's build bilateral bridges. This would be my ask for 2026.
I think these are really great insights, and just to confirm some of your thoughts, I mean, we clearly see that these emerging markets you mentioned, the LATAM, the Middle East, and other markets as well, Asia, they have a huge valuation discount compared to the US. So we're talking about 30 to 60% valuation discount for public equities and private equities, which is obviously outstanding as it's all. But more from the point of bringing the European technology into these markets, we see that the capital efficiency is much higher there, simply because of the lower prices, lower innovation costs, and et cetera, et cetera. So we see that you can bring and raise the same investment round there and get much more outputs from that. So I think this is really the most pivotal moment where we need to see the value in it. Not only that the valuations are cheap, but simply because your investments, your money would be used much more efficiently there.
Makes total sense. I have already read the Market Outlook 2026. I do highly recommend it to you. Please download it and read yourself. Comment your thoughts. Give us your feedback. We're curious to hear your perspective. I hope you enjoyed this episode of Venionaire Insights. I hope you subscribe to our channel and you tune in for our next episode. Cheers. Bye-bye, guys.
Bye-bye.
Thank you, Denis.